What's going on, everyone? Today we've got Jamie Litzler on, another episode of Midwest Multifamily, and today we're getting into some debt. So I'd love to hear a little bit of your backstory, Jamie. Tell people kind of what you do and how you got into real estate in general.
Hey, Kevin. Yeah, so my name is Jamie Litzler. I'm a mortgage banker with Marcus and Millichap Capital Corporation. So I arrange debt and equity for commercial real estate properties, mostly in central Ohio, northeastern Ohio, but across the country as needed. So um, we work with all sorts of different institutions and local banks and credit unions, like the lenders like Fannie Mae, Freddie Mac, life companies, CMBS lenders, based on property owners' business plans. So whether that be office, retail, industrial, apartments like yourself, storage, our job is to arrange debt and or equity that best aligns with you and potentially your investor's business plan. And we do it on all property types and with all different lenders. So it really depends on what folks are looking for. But got in the business about 6, 7 years ago now. First started as a lender and then left to join debt originations to kind of widen the brush of what's available and what's out there. So that's a quick background. Do a lot of apartments, stuff just like that you guys own. Would love to kind of dive into that and share about that and answer some questions.
Definitely. Yeah, and maybe share, I think this is also important because you own properties, you get the process, you know things don't happen, overnight. So maybe just share a little bit about kind of what you have going on as well so people can understand that.
Yeah, my portfolio is quite small relative to you and perhaps people listening, but I have about 4 apartment units in Columbus, Ohio, that sometimes operate as Airbnb and sometimes operate as long-term rentals. And then I've got 12 units under construction with a couple partners in Cleveland. So I certainly understand the construction process and how long it takes versus how long you think it'll take. And then as well as some small operation stuff, and just not everything goes as planned and adjusting accordingly. And the main thing actually I think is being able to underwrite for a lender versus as an operator, because they're certainly very different.
Absolutely, yeah, and that's super valuable for anyone listening. That's why don't I just talk directly to the bank? Another huge thing for us that I can share is the communication piece. We hear from you every day. You are very transparent with updates, what's going good, what's going bad, and I think that was huge for us. That's why we'll continue to work with you. And obviously, discussing things directly with banks, it's not fun to get a response a week later on pretty minor details. So I just
Or a few
want to
months
share that.
in some instances.
Absolutely. But specifically, with the commercial loans, obviously a bit more, getting into the details with the application process. Can you maybe just share what people should prepare, for kind of coming and talking to you, or they have a property under contract, and, what do they need to do?
Yeah, a lot of folks come to me and think like, I'm going to get my single family first purchase house that I'm going to live in for 30 years loan. So they don't always send the right information. So we're actually more property level focused than borrower, which is nice. So I really just need real estate information and a little bit of background on a buyer or a sponsor. So we like to see a detailed rent roll, couple years of income and expense, most notably a trailing 12 by month. And then to know your business plan, what your renovations are going to be, if it's an apartment deal with value add, or what your stabilized cash flows will look like. And then we create a story, a package to go to our lenders to go get debt feedback. As far as personal stuff, to get started, we just need an understanding of you guys, your experience, a PFS and REO, and we can hit the ground running.
Awesome. Yeah, no, that's definitely huge. And having some of those things organized for us to be able to shoot over and try and keep them current is, helpful to not scramble. And especially when things get busy with due diligence, it's nice to have those ready to go. So,
Yeah, I think the cleaner they are, the easier for the bank to review, the less questions they can ask. Less questions usually result in better outcomes.
definitely. So, obviously a lot of different loan products out there. You work with a lot of different back-end lenders. Maybe to kind of start with I'm going to say simpler process. You've got a stabilized property. There's some, cash flow there. You're going to hit debt service. You're probably going an agency route. What are the perks of that product? What are the downsides? And what does that kind of process look like comparatively?
Yeah, on a stabilized deal, you really have a couple options. You got Fannie Mae and Freddie Mac on the agency or HUD, and then you've got Life Company and CMBS. Those are kind of your non-recourse permanent products. Generally speaking, we do a lot of apartments, and that's kind of your business plan, so I'll focus in on that. That really, right now, is either going Fannie Mae, Freddie Mac, HUD on the agency, or Life Company. Not a ton of CMBS for apartments, just because there's some really good financing vehicles already out there. Agencies have a couple really good options. They're usually the longest amortization, the highest leverage, the long fixed rate, 7, 10 years, can even do longer. And they usually have generally pretty good real interest rates. Today they're call it 6 to 6.25 depending on your leverage. But agency is ultimately highest leverage, longest amortization, and a decent rate. Drawbacks are yield maintenance or defeasance. So that's a punitive prepayment penalty. So with where rates are today and where we hope rates go in 3, 4, 5 years, or a lot less than now, that could result in a pretty expensive prepayment penalty. If you were to say, I'm at 6 now, I could be at 4, let me pay this off. It's not the easiest, cleanest process. So that's pretty expensive. Life companies, pretty similar depending on the loan size, but they can go all the way up to 30 years fixed. If you say, hey, I like 6% today for 30 years, they can do it. They don't always get to the longest amortization, but they have the best rate. Certainly the lowest interest rate relative to any of the other capital markets out there, Fannie, Freddie, HUD. So, but they also have prepayment penalties as well. But the nice thing about the life companies is they're on their balance sheet, so they can get creative. Instead of 10 years yield to maintenance, can we do 6.5 or 7 or 5? They can get creative and price that in. So those are your cleanest executions, long-term, non-recourse, good amortization, and a decent rate.
Yeah, can you maybe just expand for the listeners on what non-recourse versus recourse means and what kind of the minimum loan size would be for a product like this?
Yeah, so non-recourse is generally, there's carve-outs, 6 or 7 bad boy act depending on the lender, which if you do those, they become recourse. But non-recourse in layman's terms is you could theoretically give the keys back and walk away. If the lender takes a loss, you're not liable for that, so long as you didn't partake in those 6 or 7 things I mentioned before. So generally speaking, you could walk away and the lender will take over and do what they have to do. Recourse is you are liable, so you're responsible for a lender's loss. They can come after you to be made whole, which is generally what most of the loans are out there. Single family loans are recourse. Bank and credit unions are 9 out of 10 recourse. So the majority of loans these days are recourse because they're shorter, and we can get into that, but they don't have as punitive prepayment penalties. Non-recourse agency, I'd say start around $1.5 million loan amount. Life company, I'd go a little bit higher to make it worth it, call it 2 or 3 million loan amount. There are other options, but they're partial recourse are not as attractive, so you would end up going a different route. But call it $1.5 million for apartments and call it $3 million for other product types, storage, office, retail, warehouse, that good stuff.
Got it. Awesome. Yeah, I appreciate you sharing that. Now, maybe to talk a little bit more about those value add products that exist for those, again, we're obviously an apartment, so going in, know we need to bring some capital for the renovation budget. It's not a stabilized asset. What kind of products exist for those types of properties and deals?
Yeah, you're going to look at a couple options. Your most common option these days is a bank or a credit union. So the bank comes in, they're going to give you call it 75% of your cost for round numbers. That's purchase price plus hard costs, so interior, exterior renovations. Call it 75% of that. They're going to do a couple years IO followed by, or interest only, followed by some amortization period, whether that's 25 years or 30. And their rates today are all over the place, but we're going to peg it at 7% for round numbers, plus or minus 25 or 50 basis points. So that's kind of what your bank or credit union option is. That's full recourse, guaranteed repayment, but they have a very flexible exit. So flexible prepayment penalty, maybe 3% in year 1, 2% in year 2, 1% in year 3, open, or waived on a sale, or waived if you refi with a permanent lender. So there's flexibility. Banks and credit unions can price in pretty much whatever you ask. It's just give or take. Your other option's a bridge, institutional bridge lender. So those are bigger loans, full term interest only, non-recourse, but they're expensive today. They're call it anywhere from, depending on the size, of course, call it 9.5 to 10.5% for a bridge loan. But they're also flexible, they're non-recourse, they're high leverage, maybe 75 or 80% of cost if you buy it right and spend it right. And there is a very clear exit strategy on the rents and expense. So those are your kind of two main options today for those deals.
Gotcha. Now, I know you just kind of hit on the clear exit strategy, but what scenarios do you see the bridge debt actually making sense? And given the debt market right now, do you see certain scenarios that you would suggest that option?
Yeah, we're actually doing one right now. Call it 150 apartment units in Central Ohio. And they're coming in, they're buying it for, I want to say, about $8 million, and they're going to put in another $3 million. So that's a pretty heavy lift. And occupancy is 20%. There's no in-place coverage. It's really tight. Call it a 2.5% debt yield. So that's income divided by loan amount. Very tight. Basically no income. So most lenders want a 125 cover, debt service coverage. We're at like a 0.3 or 4. So in this scenario, a bank's probably not going to do it. A bank would do it for a really strong borrower that's done a deal or two with them before. But generally speaking, that's a great bridge deal because it's also non-recourse. So we're going to get 70 plus 100, so that's 70% of price plus 100% of capex. Ends up being about 75% leverage. And it's going to be full-term IO, 3 years with a couple extension options. And that rate, I could be wrong, but I want to say it's like 8 3/4. The nice thing about that deal is it's actually fixed, so it's not floating like most bridge lenders or used to be, right? You used to do a floating rate at 4% because SOFR was 0. This is fixed. I want to say like 8.75, 3 years, and it's non-recourse. So that's a really good option where the banks probably weren't going to get to the leverage and or interest only. The downside, of course, is the rate.
Yeah, that makes a ton of sense. Do you mind maybe just elaborating on, obviously doing a couple deals with you now where there is some in-place cash flow, but we still need that renovation budget, and kind of how having a credit union that does roll to an amortization with some interest only kind of protects you as a borrower?
Yeah, so like let's think of that one deal we just did. It makes sense because you have a really big capex budget, but you don't want to be stuck in year 2 with a loan that matures and you're like, what if rates are 9% in 2 years versus 4? So the nice thing about the loans we've done together is they're generally 5 or 7 or 10 years in nature with a 5-year rate lock. So you've got 5 years of protection. The first couple are interest only, so you can do your rehab and renovate and get the properties up in occupancy and higher rents. And then they convert to some amortization, whether that be 25 or 30 years. And you start hitting P&I payments once that value add has been created and the cash flow is there. So that it's kind of the best of both worlds to the extent it's available. You've got a long-term fixed rate, so you're not stuck if rates come up in year 2 or go up in year 2. But if they do go down, you have some flexibility with a very minimal or no prepayment penalty. So that's probably why you guys have generally gone that direction, is because it limits your risk.
Yeah, absolutely. No, that's exactly the reason. It's got the flexibility there, and if rates and terms are in the gutter in 3 years, we're all right. We don't have to refinance. We're not in a position where we're forced to do it. So I think
the nice thing about them, that on like the one we did at the end of last year, I think it was, that's actually a 10-year term. So at the end of year 5, your rate adjusts, but you don't have a hard maturity where you need to pay that off.
Right.
For example, if banks are not interested in lending in 5 years, you have an option. You might not like where the rate is, or you might, but you know it's there, so you're not stuck.
Absolutely. Yeah, no, it makes a lot of sense to kind of get the mix of the bridge debt, cover some of the CapEx funds, but still have the rolling amortization.
I will say that's getting harder, right? As a few banks earlier this year closed up shop, and now banks are paying 4 or 5% to, paying you or I to put our money there, 4 or 5%. They've got to charge a higher interest rate on their loans because they're paying a higher interest rate on their deposits. So that's made cost of borrowing for real estate a little more tricky. And some are just more conservative now than others. So if I had 10 banks on a transaction last year interested, I might have 7 or 8 now. So a couple have dwindled or been on pause or or more selective. So that's getting more challenging, and rates are a little bit higher. The other challenge with rates being higher is we've got to underwrite to future cash flows, and the future cash flows have to cover that debt service payment at the higher interest rate, right? They can't assume rates are coming down or that you're going to go agency in year 3 because they have a 5-year loan. So underwriting is getting a little more stressed on the exit or on the 3-year pro forma now because rates are a little higher.
Got it. No, that makes a lot of sense too. Interesting. Now, no crystal ball, but obviously with kind of the banking news lately, the downgrade of some of the AAA plus ratings, have you seen any effects in the space? Or, I know you mentioned maybe 2 of those 10 banks now maybe sitting on the sidelines. What's actually going on your side that you're seeing from the actual interest to fund loans right now?
The interest remains high. There's plenty of financing options out there. It's just they're more expensive and maybe a little more selective. So the hairier deals take a lot more time or a little more effort on the bank side to get comfortable, or our side to get the bank comfortable. But to the extent that, there's deals to be had, there's still interest on the debt side. It's just as you as a borrower or investors, does that financing vehicle make sense for you? Can you live with 70% leverage instead of 75, and can you live with a 7.25 versus a 7% interest rate? All things considered, hopefully you can, so the deal still pencils. If you're buying the right deal at the right basis in a great location, we're optimistic that's a short-term problem, not a forever problem, and that in a few years perhaps you can refinance at a better time when banks are more interested, leverage is higher, and hopefully rates are lower.
Yeah, absolutely. Now, obviously, you guys are working in a multitude of asset classes. Is there anything that is, obviously office, clearly not doing too hot, but there's also creative operators that are coming in and doing interesting things, conversions. Are you seeing either certain banks or just banks in general really liking a certain asset class, even within multifamily or across real estate in general? Is there any trends that you see there?
I would say everyone right now is focused on good in-place cash flow, right? The creative stuff with a big jump in place to pro forma are getting harder. So it doesn't necessarily need to be a certain asset class or others, setting aside office. If there's good in-place cash flow, our lenders like that a lot more than, a barely breaking even day one and saying we're going to double rents is getting a lot harder.
Got it. Yeah, no.
But to answer your question, apartments are always very attractive. Self-storage is very attractive. Industrial is very attractive. I'm even getting more interest in retail for good retail, but those are kind of your main asset classes right now.
Got it. Yeah, that makes a lot of sense. As far as, again, no crystal ball, but you follow the Fed much closer than I do. Sounds like they may have just done a last hike for the year. What's kind of your read right now? What do you think we've got coming? Do you think we'll flatline or go down, or what's kind of your hopes and maybe then your realistic expectations?
My hopes are far different than what I expect. My hopes are that he wakes up tomorrow and just cuts them in half. But something tells me that's not going to happen for any of us, unfortunately. But I mean, again, I can't guess accurately. If I could, I'd not be sitting here being a mortgage banker. But I expect him to pretty much flatten out for a while and evaluate what goes on. I don't think there's a meaningful cut anytime soon. But generally speaking, if you look back at history, the cuts do come pretty quick there after the last hike. So I think Jerome Powell is adamant about reducing inflation and doesn't care, in my opinion, about the side effects. Whether that's right or wrong, I don't know. I just think he's willing to do what it takes to curb inflation. And so far, he's done some of that without having a large impact on the consumer from a job standpoint. So I think he's going to either stay flat or increase again and let the world kind of keep churning. And rates have to come down, in my opinion. I don't think the government can support selling treasury bills or affording their budget without a meaningful change, whether that's a reduction in interest rates or a very large increase in taxes, which I think would also be challenging to get through. So something has to change to continue down the path. I mean, 18 months ago, they were paying 1% on their 5-year treasury notes, and now they're paying 4.25%. So I think that's going to be really expensive for our government, and something has to change. It's just not as quick as we would like.
Absolutely. Yeah, no, I appreciate you sharing that. And I know I'm always asking you that question because I know you follow those things more than I do, and none of us have that ball. But if we did, yeah, it would be nice.
Yeah.
Well, as far as, just to share a little bit about our experience working with you, obviously a lot of people are always money orientated, so they see, oh, why am I going to pay this broker a fee when I can go direct to the lender? And a million times over, Ethan and I have just said, you have been super transparent. You've expedited the process every single time we've worked with you. The fee 100 times over pays for itself in the experience and how things actually progress. Along with that, maybe talk to this a little bit, but you kind of shelter us from some of the BS that the lender
Yeah.
throws at you. And I think some of that likely comes from the relationship of repeat business with these lenders. So maybe talk about how you're kind of able to protect us as a borrower and yeah, improve the process overall.
Yeah, I would say, well, first we have a great team. So we have a team of analysts and we have a team of closers, and our job is to make your life easier. So our team, we try and handle all the paperwork to the extent we can. We have everything on file from you guys from the last deal, so I don't come back to you and ask for 5,000 things to get the process started because they're just sitting there from 3 months ago or 6 months ago or last week. But lenders have a lot of paperwork, applications, setting up inspections, ordering title and all that. And our team tries to just do it all to the extent we can. We can't do everything, right? I don't know your mother's maiden name and the street you grew up on to fill out a questionnaire for the local bank to set up an account, but I can take a guess if you'd like. So, that's our job, is to make your life easier. And we go to 30, 40, whatever banks it is to get you the best feedback. So we like to think that, by getting you the best feedback, our fee pays for itself. And there's a couple added bonuses by getting our full team's attention on every transaction and working through the process for you.
Yeah, no, we 100% would agree with that, and I just wanted to make sure that people understand the value that is provided through working with a broker
And
like
now,
yourself.
now more than ever too, right? Because a year ago you could have gone to a local bank and the bank said I could do this, and those terms would probably market, right? There not a whole lot of variance out there. But now you go to two banks and one could say 6 and the other could say 8%. And who's to say either one of those are right? And who's to say that the other 28 aren't better? So now more than ever, you got to really kind of go wide to see who's in the market and what their terms are, because they're changing every single day.
Absolutely. Well, Jamie, I definitely appreciate you coming on, diving into different options that we have on the lending side. I'll end by saying, anyone listening, don't reach out to Jamie if you're trying to fund a single family home. You're specifically working in the commercial space, larger loans, larger projects. But where can people get in touch with you and learn more about what you can offer?
I will say 5 units and up on the apartment side. Happy to help. Generally a million and up in loan amounts. Commercials 2 or 3, and we do it all. And happy to be a resource for questions. But yeah, my information's on the Marcus and Millichap website. But I don't know if you can post my email in the comments or whatever of this video. Happy to be a resource for anyone that's interested in what we do or has some projects they're working on.
Awesome. Well, thank you again, Jamie. We appreciate it.
Absolutely. Thanks for having me, Kevin. Good talking to you.